Hi, and welcome to the newest episode of the Work Hard, Play Hard, and Give Back, a real estate podcast. I'm Mike Litzner, broker owner of Coco Banker American Homes, and I'm here at the studio at American Homes in Smithtown. Today, we have our guest, Vinnie DiOrio, who's branch manager at Fairway Mortgage.
Fairway Mortgage.
All right, there we go. Vinnie, welcome to the show.
Thank you, Mike. Thanks for having me.
Awesome. I just want to remind our audience that if you like what we're doing here, please like and subscribe to our channel. We got some great interviews coming up in the future. And don't forget to stay for the drop the mic question. So Vinnie, this is our first interview with a mortgage broker, and I think mortgage banker, I probably should say better, right? Yeah. And I think there's a lot of value that your industry can lend to our audience here, because it works so symbiotically, right, with the real estate industry.
Sure.
So Vinnie, you've been in the mortgage industry for a long time now, and you've even owned your own company. What first drew you to the business?
So, true story is the person that I got my first mortgage from, I believe, put me in something I couldn't really afford.
Okay.
And an adjustable rate at the time.
Ooh.
And I couldn't believe that someone that was responsible for something as important as your biggest purchase of your life, your roof over your head, your family, your investment. Yeah. I was kind of surprised at that, and I had a accounting background, and I knew a lot of people, so I was like, this can't be right.
Yeah.
So I got in the business part-time, and then took over full-time.
Yeah. So what business did you migrate from?
So at the time, I was director of ticket operations for the New York Islanders Hockey Club.
Okay. That's interesting.
So, yeah, it was good. It was fun. I was 24 to 30 at that time. It was very exciting.
Yeah.
We had a lot of contacts.
Right.
You know, it was definitely good. You got to see behind the scenes.
Yeah.
It's not as glitz and glory as everyone thinks.
Not so sexy, right?
No, not at all. It's more like a circus.
It's not sexy like mortgages are.
No, not at all. It's more hours though.
Yes.
Yeah.
Yeah. So what was some of the biggest lessons you learned from running your own mortgage company?
Running Academy Mortgage, the most challenging aspect of it was on the secondary side, dealing with larger banks that we would sell loans to.
Okay.
You know, what I really enjoyed the most was helping people.
Okay.
Servicing people. It was very rewarding. But the most challenging was dealing with other banks.
Yeah.
They're more like sharks.
Okay.
So it really wasn't.
So it's the back end of that mortgage lending where the money comes from.
Correct. The regulations, the audits, that was the most challenging.
Yeah. So now that you're in Fairway, you're in a different seat at Fairway,
Yes.
and that is all off your plate now, right?
That all liability, all
Yeah.
the regulatory side to certain aspects are off my plate. I did that to devote myself to servicing clients.
Okay.
Because that's really what I enjoy the most, is helping people.
You know, you're still a top producer. What do you think sets you apart in such a competitive space in the mortgage industry?
What's worked for me is I tell my salespeople all the time, don't go after the money.
Right.
Go after the relationship and the people, and the money will come.
Right.
A lot of my competition seems to be more transactional than relationship driven.
Okay.
So it's about getting the deal.
Yeah.
Where I'd rather think outside the box, give people their options, explain to them, you know, it's a big purchase. And now with the way prices are here on Long Island, this is serious. So
how have you seen over the last 5 years the average mortgage amount? How has it changed for you? What would you say your average loan closed today is?
Average loan amount is about $550,000.
Okay. How different is that from 5 years ago?
Oof. 5 years ago is probably about $380,000, $400,000.
Okay. So it's up anywhere 30 to 40%. You'd say?
Yeah, and I'm thinking it's going to increase from there because house prices seem to be increasing as we speak. So
yeah, very much so.
Yeah.
How have you seen the mortgage industry evolve over the years, and really how have you adapted to stay ahead of it?
It was easy for me to adapt because the business model of putting clients first works in every market, every changing market.
Right.
people are people.
Right.
So rates can change, prices can change, mortgage products can change, but people's families and affordability doesn't change.
Right.
So the goal is always to make that customer as happy as possible.
Right.
And the rest kind of takes care of itself. And then in the slow times, that's where the referrals come from.
Right. We've both seen over the years the advent of technology, which has made information available to the consumer, the end user, right? So they can Google anything. At the same time, how educated do you see as the average borrower come in? How informed are they really?
Not as educated as they should be.
Yeah.
And I think they know that because you could Google, the internet is always great because people are quick to put it on the internet.
Right.
But not take it off.
Right.
So certain things are dated.
Okay.
Don't exist anymore.
Yeah.
And then there's always the art of structuring the deal.
Right.
Where it's not just what's your rate, down payment, here you go, have a nice day.
Right. Loan to value.
Yeah, it's looking at their overall, debt, what's their other monthly obligations,
Right.
Does the house need upgrading, does it need work? So there's always the avenue of what makes the most financial sense overall.
Right.
Where I think most people kind of get sucked into the lowest rate is the best mortgage.
Right.
Not always the case. It's the lowest payments
Right.
are the best mortgage.
Okay.
There's a difference.
So what advice would you give to a new home buyer that's competing in today's marketplace?
Be as strong as possible financially, whether it's down payment.
All right. There you go. I was going to elaborate on that.
Yep. A lot of people now, to get their offer accepted, they need to do what's called waive the appraised value.
Okay.
What that means is if the appraisal comes in shorter than the offer price, that they'll still go ahead with the transaction.
Okay.
So
now what's the risk with that, though?
It depends on down payment.
Right.
If you're even 10% down or more, there's really no risk.
Okay.
Obviously, if you're spending $100,000 more than it's appraised for, that's bad. But I haven't seen that.
Right.
If it's if an appraisal isn't coming in, it's usually between 2 or 3%. Doesn't really impact anything. But a 5% down could kill the deal.
Correct.
So if you're a buyer with 5% down, it's very important to meet with a mortgage advisor to really structure yourself to be as strong financially as possible to be considered seriously.
All right. Just for our audience, again, because some of them are, we have a big agent following, so they're going to know the industry jargon. But I think the average consumer hears things about appraisal. They understand the idea of appraising the value of something, but I don't think they understand why. So correct me if I'm wrong, but for our audience who's, again, maybe a novice at this, we incorrectly say we're going to the bank for a mortgage, and essentially what we're doing is going to the bank for a loan. We give the bank a mortgage back or a lien against our property. That property becomes collateral, correct?
Correct.
All right. And typically the bank wants to appraise the collateral to make sure it has sufficient value to secure the monies.
Correct. The banks are lending the money for the loan based on the value of the property.
Right. And the consumer's ability to pay back as well.
Of course.
Of course, yes.
But so the appraised value, it's done by a licensed appraiser, not controlled by the bank or anything like that. It's a third party. Comes in, evaluates. Typically, it's similar houses, square footage and condition.
Comparables, as we term, right?
Correct.
Our real estate people know it as comparables, right? Or comps, right?
That have closed within a half-a-mile radius within the last 6 months.
How much does zip code / school district play into the half mile? So, because, especially on Long Island here, we have numerous districts and what have you. You could be in the corner of a school district / zip code and you crisscross. And so your half mile, what does that impact?
So the comparables an appraiser is going to use is typically the same school district.
Okay.
So even if it's a half a mile, if it's a superior school district in that half mile, they'll use comps for a similar school district.
Okay.
but they can make adjustments for that.
Okay.
So in simpler terms, one house has a 2-car garage, another house has a 1-car garage.
Correct.
They'll adjust down for the 1-car garage.
Right.
They'll take away some value there.
Right.
Same thing with school districts.
Okay.
Property size.
Right. Or adjust up where maybe there's additional square footage or additional bathrooms per se, or
Yes.
other features, value-added features.
Correct. Like the biggest battle I have with consumers more than realtors is Zillow is not accurate.
Oh, yeah.
So-
Okay. This is a really good point to touch on here. It's just an algorithm, right?
That's all it is.
Yeah.
It doesn't understand condition of the property, doesn't understand what's inside the house, doesn't understand if there's a family transaction.
Yeah.
You know?
Right, arm's length, yes.
Yeah, if that house sold for $100,000 less than market value, that's
Right.
because
It's a
the
family
child
member. Yeah.
bought it from the mother
Right.
or father.
And that throws off the algorithms.
Yes.
So coming back to the appraisal, if someone waives the appraisal, it takes out the risk factor for the seller, is what you're saying, and it helps them better position their offer as more competitive in a competitive market.
Correct. It also means that the buyer is more serious. So in other words, I'm making an offer on a $900,000 house that's valued at $799. We've seen this
Right.
recently.
Right.
$799, it's priced low. All of a sudden, there's 20 offers on the house.
Right.
So I'm offering
Bidding war, yes.
Yep. I'm offering $900
Right.
on a $799 asking price.
Right.
Everyone's worried, well, what happens if the house doesn't appraise for $900?
Right.
Well, the truth of the matter is, even if you have a 20% down,
Right.
all banks could do 5% down financing. So not to bore you with calculations,
Right.
but that means you have 15% wiggle room
Right.
that if it didn't appraise. Now, obviously, it's not going to appraise 15% less.
Yeah.
But the bigger the down payment, the less risk
Right.
of it affecting finance.
Right.
5% down or 3.5% down, you really don't have any wiggle room. You can't do that as a buyer.
Yeah, because the bank's not going to lend over certain LTVs. So if you have
Correct.
3.5% down and the appraisal comes in 5%, they're not going to lend more than 100% of the value of the house.
Correct. Unless the buyer has the money to make up the shortfall.
Yes. Okay.
But if they did, odds are they're not doing the 5% or 3.5% down anyway.
Correct. Correct. And again, just for clarity, from the real estate side. So it's the real estate brain talking to the mortgage brain, and it shows how these things interlock and what have you. But the reason sellers care about this so much is the standard contract of sale is typically contingent upon a buyer's ability to get financing. So if there's obviously a cash deal, they're waiving that contingency. So the deal is typically not contingent upon appraisal, but if that appraisal comes in so short that it prevents that buyer from attaining the mortgage, now it's the mortgage contingency comes into play. So essentially what people fail to recognize is that when you're negotiating to purchase a house is that you're not just negotiating price. It's the terms. If you can't get to the finish line or there's high risk whether you're going to execute on that contract, the seller takes that into consideration, and it hurts your position in negotiations.
Right.
So this circles back to the appraisal as being one of the wild cards that come into play, especially in a market that we've seen for the last several years, nothing but bidding wars.
Right.
Right.
So in the same scenario of someone offering $900,000 on the $799 house, one offer doesn't waive the appraisal
Right.
value. The other offer does.
Right.
The one that does is going to appear stronger, even though the terms are exactly the same, but one's waiving the appraised value. Takes away the fear from a seller, oh, what happens if it appraises for $880?
Right.
Well, in this case, it doesn't matter.
Now, there's rumors, or not rumors, I've seen scenarios where banks are actually, or mortgage lenders are actually waiving appraisals.
Yes.
Can you share with us, because it seems to be an inconsistent process, so we don't know where or when or how that's being leveraged. But that could help alleviate the fear of a purchaser knowing I got an appraisal waiver anyway, so I can offer that waiver. What does that look like?
So we don't know either.
Okay.
And they're not going to tell us because then we would figure out how to manipulate, whether it was down payment or credit score or something like that. Basically, my understanding is data that Fannie Mae or Freddie Mac has
Okay.
in that particular area has nothing to do with LTV,
Okay.
nothing to do with credit score or borrower.
I would think it would be LTV, meaning loan to value for our audience, because if someone's putting 50% down, they're still getting 50% financing, but what's the likelihood this thing's going to come in appraised 30% under it? I've never seen it. I've never even seen anything close to that.
No, but for them to actually waive the appraisal,
Right.
they don't know it's really 50% down, right?
Right.
Because if it appraised for less,
Right.
then now it's not 50% down of the value.
Right.
It's 50% down
of the
price.
contract price. Right.
So we had a scenario with the Nespika Park office.
Okay.
Dan Murphy had a client buying a house in Huntington
Okay.
for $900,000.
There you go.
Now you're thinking, well, okay, I'm not going to get an appraisal waiver on a $900,000 house.
Right.
We did.
Okay.
And that was just based on the information we upload electronically to Fannie Mae or Freddie Mac,
Okay.
and they'll tell us whether an appraisal is needed or not.
How early in that process can you upload that information? As soon as they get if Dan comes to you when he's making the offer and he says, here's the address we're bidding on, how fast can you find that out?
But basically, as soon as they have an accepted offer, we could do that.
Okay.
Can we do that before? We can. It just gets complicated doing it on every offer because
Okay.
once you have enough information, you're triggering RESPA. So
Okay.
you have to disclose application. So you don't want to put the
Yes.
buyer through an application every time they want to make
Right.
an offer.
So the disclosures is really what RESPA gets back to, is all the disclosures. It's heavily regulated industry as it pertains to finance. Is that correct for our audience out here that is not in the finance business or necessarily real estate?
Correct. So that same situation, Huntington 900,000, no appraisal needed.
Right.
Doing a loan now with someone with 30% down,
Right.
getting a actually what I think is a good priced home. It's Larry's sale, Larry Theodore,
Yeah.
and I would have bet we would have gotten an appraisal waiver,
And nothing. Huh?
and we didn't get the appraisal waiver. So it's really my
It's a
experience.
case by case basis.
It's what if they have enough data
Yeah.
in that Fannie Mae or Freddie Mac, if they have enough data in that zip code,
Yeah.
square footage, which over time they are compiling.
Yeah.
Because every appraisal now has to do an HTML upload
Okay.
of information more important about the house.
Right. Right.
So as they compile more data, technology gets better,
Yeah.
and we maybe someday won't need appraisals at all.
So it should, 40 years doing this, and the appraisal have been a staple of this industry. So let's hope, because anything that can simplify the process would be great. How would you best deal with potential buyers who are trying to overcome the challenge of a minimal cash investment?
It depends on the individual. A lot of time, most of the time, I don't mandate it, but I tell people it's better to have a sit-down face-to-face
Okay.
meeting,
Yeah.
so I can show them different options and what goes on.
Yeah.
And
So maybe describe, I don't want to say dumb it down, because again, we have a lot of realtors, so this might seem simpler to them, but if there was a prospective new first-time home buyer out there, I want to make sure we convey information in a way they can digest. So what would you consider the minimum down payments for someone to purchase a home today?
in this market, to get an accepted offer in our area, 10% down is kind of the minimum that I see.
Okay.
I do
So
have people making 5% down and 3.5% down offers.
Okay.
They are getting offers accepted, but then I'll give the client the information
Right.
on what makes them strong.
Okay.
And then it's up to them if they want to relay part of that information or all of that information to the agent presenting the offer.
Okay.
In other words, to a real estate agent or a listing agent,
Yeah.
sometimes speed is a factor. House is empty. Maybe it's an estate, someone passed, they want to get rid of the house
Right.
fast.
Time is money for the seller. They're
Yes.
paying taxes, a vacant place, utilities.
Correct.
So-
Closing quickly sometimes is an advantage in some
Right.
situations. Some people's credit scores.
Right.
If they have an 800 credit score, I'm not going to tell the agent what the score is, but the client could divulge whatever they want.
Correct.
Debt to income ratios.
Right.
Some agents understand what that is and some don't. If
Right.
someone's got a very low debt to income ratio,
Yeah.
the buyer might want to convey that.
So let's lean into debt to income ratios. Obviously, someone knows what their income is, but what is qualified debt for our audience out there?
Officially, there's two ratios, a front ratio
Right.
and a back ratio.
Correct.
The front ratio is the mortgage payment, or as we call it, PITI
Right.
in the business, principal, interest, taxes, insurance,
Correct.
divided by their gross monthly income.
Right.
That gives us a housing ratio.
Correct.
The total debt ratio is the
Back end.
PITI plus car payments, credit cards, student loans, anything that appears on their credit report.
Okay.
That combined with the front, the PITI, is their debt ratio. You take that, divide that by their gross income,
Right.
and we get a percentage.
Okay. Let me just put this out to our audience who's in the home buying market. If you haven't sat with a mortgage professional first before going to see houses, you're wasting your time, because you might find that you're going to be able to qualify for a loan $100,000 less than you think, or you might find out, I've seen where people can qualify for $100,000 or $200,000 more, because there's just nuances in there they just didn't anticipate. They were being over conservative, and they were missing out on properties that really would have fit their price range. And I often like to say this, Vinny, is people incorrectly go shop price when they're really shopping monthly payment.
Correct.
right?
Good example of that is real estate taxes.
Yes.
You might have a price in mind. That price could be $1 million,
Right.
based on $18,000 annual real estate tax.
Correct.
But now you find a house with
24 or 28. Yeah.
$28,000 in real estate tax. Now your purchasability is less.
Yeah.
So it could go back and forth. Sometimes depending on the property,
Right.
you might be able to go higher than you think.
Yeah. And for our audience that's not in New York, yes, he did say $28,000 a year. I talk to people around the country, and do you really have $28,000? Yeah, I'm sorry.
Yeah.
I don't understand how New York has normalized $28,000 a year. I think that's a different topic for a different podcast right now, but we'll leave it at that right now.
I don't think there's anything normal about New York. Mike.
Yeah, exactly.
We're unique.
Yes, we are. We are. I believe, and correct me if I'm wrong, that the typical purchaser, especially the newer they are, like a first-time buyer as opposed to someone who's, done multiple transactions, tends to shop rate first. Mm-hmm. Okay, and then later on they realize there's a lot more nuance. So what's a slippery slope on this? Because obviously we can get into things like, anyone can say any rate, because if it's not locked in, you get prevailing rate. Okay, so there's a game that's played. Am I correct on that?
There is we call it bait and switch.
Right.
There are competitors out there that will blatantly lie about an interest rate that's not available. When people tell me that, I would say most of the time, 99% of the time,
Right.
if you just educate the buyer
Right.
and inform them, they kind of detect that it might not be true.
Okay.
Or it might be aggressive marketing,
Right.
we'll call it.
Right. I mean, most of you are going to the same secondary market, so it shouldn't be a wide range unless there's a different product. Obviously, an adjustable rate would be lower today, but you're going to run the risk of when it adjusts and what the market and economy is doing, as opposed to a fixed rate. But if it's product to product, should there be that much more variable in the rate as much as?
No,
it shouldn't be.
It should relatively be close.
Right.
When I say the most aggressive priced rate and the worst rate shouldn't really differ more
Right.
than a quarter to most a half
Yeah.
percent.
Okay.
And
That's what I've seen, and you know, so it's interesting when people are rate shopping, and then it's like, but relax, you know, because unless they're locking in to that rate, then they're not delivering it. And so, what's the problem with locking in?
so
For our audience that needs to know, well, why don't you just lock in from the beginning?
because
so what's the
you have
challenge?
no idea when they're closing.
Correct.
So the contract, especially in New York, being unique, we have
Correct.
on or about dates,
correct.
which means it's a target date. They can, if you have a on or about July 1 closing, means they can close as late as August 1.
Right, and not be in violation of the contract.
Right. So when someone locks in, they need to lock to cover August 1.
Yeah, not just July 1.
Correct.
What's the traditional lock-in time frame that doesn't cost you an arm and a leg?
I think 60 days,
Is long.
you know,
That
is-
seems long, though.
is the typical
Yeah,
contract date, unless the seller wants longer.
right.
You know, I have some people that aren't locking because the seller didn't find a house yet.
Okay,
So they applied, haven't locked because they might not be closing until like September or
Yeah.
October.
yeah.
So
So, they're floating out there.
they're floating, taking a little bit of risk.
Yeah.
What we've seen is I don't think it's as risky as
Right.
it was a few years ago. We went from 3 to 7 in 6 months.
Yeah, in 40 years, that's the only time I've seen not only a rate double, but almost triple. Because we did top out around 8, and we probably hit bottom out around 2.5
Right.
to 2 3/4. So it actually almost tripled in a 6-month period of time.
Right.
It was chaos, you know.
Tell me. It was
Yes.
like, in my industry, it was like shutting a valve off.
Yeah.
It just stopped.
Yeah.
Now people have gotten acclimated. They've understood now.
Yeah.
And the other thing about interest rate, the biggest surprise to most buyers
Right.
is it's not as big of a deal as they think.
Right.
Like 6.375 and 6.25
Right.
is marginal.
Yeah.
It's probably, depending on the size loan, $10 or $15 a month.
Right.
But people think
Right.
it's kind of like that old marketing strategy.
Yeah.
5.9 isn't 6.
Right. Right.
So it's not, again, educating the buyer is the best thing for any mortgage guy. I hate to tell my competition things, but
No, that's
educating them, and educating them is the best thing for the real estate agent
Yeah.
because it makes their job so much easier the more educated the buyer is.
Right.
Sometimes I'm brought into a situation where they were pre-approved. The realtor didn't know the company they were pre-approved by and said, why don't you get a second opinion
Right.
from my guy Vinnie? They were pre-approved with 20% down. They didn't have the 20%,
Okay.
which means they also didn't have money for closing costs.
Okay. That might be a problem, huh?
A little bit.
Yeah.
So now when the customer sees, and unfortunately there are some customers that don't understand what 20% down is. I'm like, why would you do 20% down? Well, that's because I was told that would be stronger. Yeah, but $700,000 house, that's $140,000.
Correct. Yeah.
And because we are unique in New York, closing costs on that could range between $30,000 and $45,000, depending on what they want to do.
What's the difference between a conventional loan and a jumbo loan for our audience?
The exact numbers I don't know off the top of my head, but a jumbo loan now is over $1.2 million.
Okay, they did. I know they raised the.
Yeah, so there's actually
It's the
three.
loan amount, right?
Yeah, there's actually 3 types. There's conforming,
Okay.
then there's what's called high balance, and then there's jumbo.
Okay.
But a lot of people will say the high balance is jumbo.
Okay.
So you could actually borrow $1 million, 1.1. It's a high balance loan,
Right.
but it's not a jumbo.
Okay. Are there advantages to jumbo or disadvantages or both?
It's going to depend on credit score
Okay.
and loan to value. So when you're in the jumbo area, there are times you can get a better interest rate
Right.
than if you were borrowing $700,000.
That's interesting.
Yeah, because it's more geared towards
High net worth people.
yeah,
Yeah.
and they want those loans.
Yeah. So less likely to default if you're putting 40 or 50% down, and
Yeah, and it's a
buying-
different. Not to
yeah.
get too technical, but it's a different mortgage pool.
Yeah.
So when you're high balance or less, you're pretty much in the pool of Fannie Mae, Freddie Mac,
Right.
Ginnie Mae if you're FHA or VA. So those mortgages are pooled together and sold on Wall Street, where the jumbo is a different pool.
How many states can you write loans in?
I can write loans in 15 states, but we could do all 50, but I personally can't write those states. I could refer it to someone in the company.
Okay.
But the reason why I did the 15 that I did is because I have clientele over 26 years selling in New York,
Yeah.
now buying in other states.
Right. Right.
Obviously, Florida was always
a big
New
one.
York part two.
Yeah. I assume it's the Carolinas, the big part.
South Carolina is big right now. Florida
Yeah.
is big. Over the years, not recently, but Pennsylvania has always been big.
Okay.
But I'm starting to see some bleeding over into New Jersey because we're having a inventory problem here on the island.
Yeah.
So they're just going to the other side.
Right. Where there's more land.
Yes, they can go inland.
Yes, exactly. So can you share with us an interesting or uncomfortable challenge you had to overcome while closing a deal?
The challenges that I've run into basically are maybe title, because title in New York will take 2 to 3 weeks to get.
Yeah, just the CO search.
So we've been approved, waiting for title, and then you get title, and there might be a chain of title issue.
Right.
You know, for those of you who don't know what that is, it just means the history of who owns the property and was it conveyed properly.
Right.
Challenges, the most common challenge I think we run into is prior mortgages on the property not being recorded.
Okay. So someone has to dig out a satisfaction.
Yes, or the title company has to research from who the other title company was to omit that. So that's the biggest challenges I see. Again, it's
all those little nuances that the typical buyer or seller doesn't even see that happens behind the scenes before you can clear to close, right?
Yeah. Lending wise, you really shouldn't run into challenges if you did all your due diligence up front.
Right.
The more thorough you are up front, the
Right.
less chance you're going to have an issue.
Yeah.
An issue you would have on lending is, I call it the grenade goes off, where the borrower didn't specify something
Yeah.
and it wasn't on their credit report,
Right.
or they intentionally didn't tell us because they knew it might be an issue. Then it comes up
Oh, they bought a car between contract and closing. Has that happened to you?
several times.
Yeah.
Furniture too, a house full of furniture and a car.
Yeah.
You know, it happens. But that's where knowing the customer and building the relationship, you can pivot,
Yeah.
because now
You can coach. Hopefully, you coach them ahead of time not to do that. So
we do. We give them something in writing, warning them, and
Yeah.
I didn't know it would be a problem. But the stronger your relationship with the borrower,
Right.
the more you can get around stuff like that.
Yeah. Exactly. Exactly.
Now, well, we run into challenges where if someone's self-employed,
Yeah.
and obviously they're not reporting
Yeah.
that much to the IRS,
Yeah.
but you could, if you did a thorough job, you've structured the loan either with a cosigner or something that,
Right.
to make it
Right.
to
Exactly.
make it happen. So that's why the face-to-face
Really important. Yeah.
it is. And most of my competition, even some of my own
Yeah.
coworkers,
Yeah.
they'd rather not do the face-to-face, but
It's so much better.
it is, and it's you get more referrals. You know, I mean, in all honesty, I get referrals from people that I haven't done a loan for. I purely pre-approve them, and they're already referring me people because I did something that no one else did. I sat down with them, took an hour.
Yeah. The personal
half.
touch.
Yeah.
There's a lot of nuance to it, and people think again it's easy. I'm just going to go out. I have this new app, the hottest new app for financing. It's like there's so much layers of nuance to this that gets overlooked. Okay, so Vinny, we're going to pivot a little bit. We like to interact with you a little bit more on a personal level. So, what's something you're passionate about outside of mortgages that people might not know about you?
I think one of the things that the people that know me and are close to me that's also a fault is that I care. I put myself out there too much. You know that expression, no good deed goes unpunished?
Yeah, yeah.
As dedicated I am to work is as dedicated as I am to personal life. So,
Okay.
of course, that comes back to get you, as we all have experienced.
Yeah. But what does downtime look for Vinnie DiOrio?
The downtime is time with my kids, barbecuing in the backyard. It's more of a simple life. One of my most favorite things is going out to dinner with my wife to a place where hopefully nobody knows me and it's just quiet.
Doesn't ask any mortgage questions.
You're talking all day. That's what we do for a living. 7 days a week, texting, emailing, talking. So when I'm out to dinner, I like to be out to dinner and just
unwinding, just letting go.
The most satisfying time is being in my backyard, my dog Coco running around and barbecuing and just having the Yankee game on TV. Sorry for all you Met fans out there.
Including me.
Yeah.
It's all right. So, Vinny, do you have any daily habits or rituals that help you stay focused or keep you energized?
I know a lot of people say they go to the gym, get up early, do all that stuff.
Yeah.
That's not really what drives me. I get bored easily.
Yeah.
Again, it's a gift and a curse, but what drives me is fear.
That's interesting.
I don't want to fail or lose. It's competitive. It's not about the money. It's not the number.
Right.
It's the transactions and it's winning that keeps me going.
Yeah.
And I think the biggest thing what does it for me is, and from what I've seen from every top producer, is self-accountability.
Right.
If I didn't get a deal or something went wrong, I don't blame anybody else. I say to myself, could I have done better? What did I do wrong?
Yeah.
So I wear it, breathe it, sleep it.
Yeah.
So I'd love to say that there's some sort of ritual or tradition that I do.
Yeah.
But it's just more of, it's out of fear.
Yeah. So just how competitive is Vinnie DiOrio? Are you the one, if you're playing a board game against your kids, that you got to win?
I don't let them win.
No, there we go. There we go.
No, I'm not that competitive to regard. But in business, I've been called a psycho. But that's a compliment. So I would say as competitive as you want to just keep going. You just want to win. That's the rewarding satisfaction of what I do, right?
Yeah.
You get people in homes. If you're refinancing them, you're saving money. That's rewarding.
Right.
It's not the money. I don't look at how much I'm making on a deal.
Well, I guess when you win, your client wins. So you have to win together, which is when you're doing the business correctly. That's the takeaway.
It's actually the opposite. When the client wins, I win.
Okay.
Yeah, that's
okay. I'll take it either way. You're aligned, so to speak. So it's the bottom line.
When that buyer gets an accepted offer in a competitive market with 10 other offers on the house, it feels good.
Yeah, you've prepped them the right way.
Yeah,
because negotiating in a competitive marketplace is an art form. So
and it's 24/7. That's the part I don't like. It's technology and cell phones. I never used to give out my cell phone. Now
you live on it.
Yep.
I hear you. All right. Well, let's touch on something else. The rumor has it you're a dog lover. Is that true?
That is true.
Coco, is that the
Coco?
dog?
She's a little 15-pound Bichon Poodle mix.
Yeah.
And she's really the star of the show.
Okay.
We get testimonials. Thanks, Vinny and Michelle and your team, and especially Coco. I've had even clients close on a house and bring Coco gifts.
Really?
Yeah.
So, Vin, I want to pivot to talk a little bit about giving back. But before I do, I just want to remind our audience that if you like what we're doing here, please like and subscribe to our channel. We got some great interviews coming up in the future. And don't forget to stay for the drop the mic question. Giving back. I don't know if all your clients and members of your community know how generous you have been to the Heart of American Homes Foundation. It's our company-wide nonprofit.
But before Heart of American Homes Foundation, my son has severe special needs.
Okay.
And he went to school in Massapequa, Hagedorn Little Village.
Okay.
And that was my main cause.
Okay.
Because what they did was fantastic.
Yeah, good.
He's aged out of there. He's at Carmen's Road now.
Okay.
I kind of took on the cause when I've learned what Heart of American Homes does.
Right.
And, you know, again, it's not a kiss up thing, but when I've met you, Tom Gallagher, Marie Asher, Tom Murtaugh, it really is amazing that you people care.
Right.
And one of the things I try to surround myself with over the years is I'm a good person in a bad business.
Okay.
So when you meet other good people
Right.
in a bad business, you want to surround yourself with them.
Right.
And
Right.
what I've learned that you guys have, what you do in the cases, it's really amazing because I don't really know other people in our industries that give back
Yeah.
as much and put so much work
Oh,
into
yeah.
it. The work that you all do.
You see the
is-
fundraisers, right? But they're a lot of fun, aren't they?
Yeah, they're great, and it's just amazing that you give back. But it is a lot of fun. It's good not to talk about mortgages and real estate and have a fundraiser and laugh, pick on each other.
Yeah.
It's all a good cause.
Yeah.
So that's kind of been my go-to now.
In your experience, what's one thing the mortgage industry could do better to serve people, especially in the underserved communities?
It really all comes down to the same thing. Put people first.
Yeah.
Service. One of the things I try to explain to everybody is when you go for the money, you're not going to make it.
Right.
You've got to go for the relationship. If you
Right.
go for people, the money will come.
Yes.
Whether it's high-end, underserved, middle income, low income, I treat everybody the same.
Right.
You know, you educate them, you inform them, and you try to help them as best you can.
Right.
You know, the market dictates what the market dictates. Unfortunately, sometimes people get outbid or can't compete.
Of course.
But what's rewarding to me is you sit down with someone that you know you're going to have a hard time finding a house on Long Island, but they're so appreciative that you took the time.
Yeah.
And I tell everybody, you might not be ready today, but we'll sit down, we'll have a plan, and I'll inform you on what you need to do to get in place.
Right.
And they're so heartfelt and appreciative that you just took the time, because everybody else, if they couldn't get a loan or there was a small loan, people would like hang up on them.
Yeah.
So really, underserved, it doesn't really matter. It's
Yeah.
care.
Good. I like that. I like that. Are there any community programs, especially around financial education or first-time home buyers, that you support or would like to see more of?
There are. It's challenging because, again, we're unique being in New York.
Yeah.
So the government does have programs, whether it's FHA, whether it's Sony May, State of New York. There are programs out there to help people, down payment assistance. The problem that I see in our area, and probably everywhere, is the government is always great at saying what they offer people.
Right.
But then when you find out who qualifies,
Right.
it's nobody or next to nobody here in New York.
Right.
So in order to get that grant, that down payment assistance, you have to make under a certain amount of money.
Right.
Now, if you make under a certain amount of money, you can't afford to buy a house on Long Island.
Right.
So
It's a catch-22.
I guess a lot of what I would like to see locally
Yeah.
might not necessarily be mortgage products or down payment products. I would like to see more developing residential housing.
Yeah.
You
Supply
know?
and demand commands the price of every product, and they don't let you develop.
Yeah.
Not my backyard, and when there's not enough inventory, the prices go up, and then they complain that the prices are high. So it's
Zoning needs to be done faster. more efficiently.
Yes.
You know, as a local Long Islander, you drive around, we all see empty strip malls.
Mm-hmm.
We see empty office buildings. The senior housing would help the housing crisis on Long Island.
Right.
Because there's nowhere for anyone to downsize to.
Right. Or
So they stay in their
certainly
house.
not enough. Yeah.
Right. So I go to other places. I was in South Carolina not too long ago. They've got like communities where they have
Yeah.
shops, restaurants, townhouses with 3-bedroom with attached garages, and it's just phenomenal.
Yeah.
We don't have anything like that here.
Yeah.
It would be great.
Yeah.
So that's what I'd like to see more of.
Yeah. Creating more opportunities for people like that.
Yeah, because the more exotic mortgage programs we get, I think
Right.
that's just going to compound and make the problem worse.
Right.
Because now house prices go up because now
Yeah.
more people can buy. So I think if they could figure out a way to get us more inventory that
Yeah.
makes sense,
Right.
that is what I'd like to see.
Fair enough. Well, Vinny, I appreciate your insights. You've been very helpful, certainly to our audience here today.
It's time for the Drop the Mic question.
So we always like to have a little bit of fun
Here
with the
it
drop the
comes.
mic question. So what's the most wildest or memorable closing experience you ever had?
The wildest closing experience wasn't actually that long ago. I think it was about a year or two ago.
Yeah, yeah.
But I went to the closing. I'm at the closing. And I guess the seller was a divorce situation.
Yeah.
And one of them freaked out,
Yeah.
ran out of the closing,
Yeah.
got in her car, and took off like screeching tires out of the parking lot.
Okay. Before signing all the paperwork?
Yes, of course.
Okay.
So that was probably the most entertaining closing I've ever seen.
Yeah.
And we're all just looking at each other, not knowing what to do. The listing agent, of course, ran out and chased.
Screeching tires coming out of the parking lot.
Right. But needless to say, it did close.
There you go.
She came to her senses and signed.
Yeah, it's a channel. So there's a lot goes into, life-changing moves, which, many times is a big part of it. So, well, Vinny, I think, again, we appreciate you being on the show. If anyone's interested in, finding out a little bit more information about some of the topics in mortgages, finance, and the nuances there, how do they reach Vinnie DiOrio at Fairway Mortgage?
So you could call me on my cell, 516-457-1991.
Okay.
Or you can email me at vin@home.com. vin@home.com.
At home.com. All right, good. I like that, and it's appreciate you. You're a real professional. Gave us a lot of information. So thank you so much for being part of our episode here today.
No, thank you for having me. Glad to be here.
Great.